Markets Forward with Sahil Kapoor, who is joining us from DSP Mutual Fund. He's, of course, head of products and also a market strategist and a practicing economist as well. Sahil, afternoon. Thank you so much. Every time you come on my show, it appears you've shed some more weight. What exactly is happening? Are you Benjamin buttoning or what? So
No,
clearly,
it's exactly the
working
same.
out.
Yeah. No, Ajay, it's exactly the same.
Okay.
Thank you.
So, we'll talk about markets now. Sahil, I want to understand that this time your Netra report usually is a mix of, stuff which is what you can derive about market investing, but centers around data points, mostly macro and of that nature. But this time around, you have devoted the note to Mr. Munger. So, what exactly is the biggest learning from the life of Mr. Munger, which Mr. Munger, which we can implement in day-to-day investing?
Sure. Ajay, every anniversary edition, we try and zoom out and, look back and look at what are the timeless principles that we can learn and reinforce. And of course, in the month of June, there was already so much noise, a lot of people talking about elections and other outcomes. So we thought this is the right time to think about long-term investing principles. With Charlie Munger, I think one of the investing greats, not only he's given a lot of investing wisdom, also a number of ideas from Charlie is all about living correctly. So what we've highlighted in the report is what, a lot of people have said the right stuff that Charlie espoused. And probably one of the most important learnings, I'll put two major learnings, at least which are my major takeaways from the whole exercise. First is, Charlie's multidisciplinary approach. I think more often than not, most of us become very ultra specialist. For Charlie, sometimes a quotation is used that this was the guy who knew a lot about a lot of stuff and a little about everything else. So I think one very important vector which Charlie gave was his multidisciplinary approach, getting basic ideas from every discipline, whether it is in science, which is physics, chemistry, biology, mathematics, psychology, etc., and then understanding what could be the Lollapalooza effect, which means that how can number of factors come together and create something that you can identify and then probably participate in. So I think from trying to identify a number of factors coming together, you need to have a multidisciplinary approach. And I think that is something very, very important. And recently, I also thought about a new word. You could call it an intellectual butterfly, which sits on various flowers and try to get nectar out of various spaces and then try to build them together into probably a beautiful color. So that is, learning number one, a multidisciplinary approach. And second, which is my favorite, is probably reading. I think Charlie Munger and Warren Buffett both have been readers, and they have said again and again that they specifically earmark time every single day to read. And there are so many principles that Charlie has taught us, but I think if there is one principle, which is reading, probably reading books, which can help you learn everything else. I think this is it, reading, and it is probably also one of my favorites. So I'm also a little biased about it. So my sense is that if you read extensively across topics, across history, it will serve all of us well, particularly the investors.
Right. The other point which I would like you to scratch a little more is the long-term orientation investors can have about the market, because I was just talking to Chetan Aya of Morgan Stanley, and he also was making a point that sometimes we get so kind of caught up with the GDP, high GDP number, that we don't understand what a moderate GDP number can do, but spread over a prolonged period of time. So right. 6.5 looks not so sexy enough. We are hung up with 8, but 6.5 itself can take us to 8 trillion if we see it on a CAGR basis of 8 years till 2030. How do investors reorient their brains toward long-term orientation?
So I think one of the principles is to be slightly more conservative. I think a lot of investors believe that an X number of returns is very easy to get, or probably we are entitled to get. And domestically, I think we look at nominal GDP and then we extrapolate that number. So for example, look at last 30 years. Nominally we have grown between 10-11%, and our markets also have given between 10 to 12%, whichever date that you take, in terms of nominal CAGR returns over this period of time. But when you look at real returns, you subtract 6.5% GDP numbers, 6.5% inflation numbers, you get to a return of between 4-5% in terms of CAGR. And we looked at about 16 to 20 countries globally. And it's a surprising fact that no country in the world has generated double-digit real returns over the last 30 years. And India and US, of course, are two markets which have generated these kind of returns. And second thing is, when probably, one of the easiest way, which all of us mutual fund people talk about, is systematic investment plans, which means adopting a more disciplined approach. So for example, if you did a SIP in India for the last 30 years, you made 12% nominal returns on the currency. If you adjust for inflation, you get about 5-6% real returns, which is excellent return, right? 6% above inflation is a superb compounding. But the point is that all these returns are not very, very normal. They are exceptional. Very few countries have been able to do it. And our data tells us that no more than 2 to 3 countries have been able to deliver 5 to 6% real returns, even for investors who've been the most disciplined. Doing a SIP for 30 years is a very, very hard task. So two conclusions. One, investors should tone down their return expectations when we hear numbers like 15, 20%, 25% CAGR. No markets have delivered these kind of returns historically across the world. So I don't think we are entitled to such returns, or even if we get it, I think it will be a lucky break. And second, and more importantly, investors should focus on a more disciplined approach for long-term investing. That means that looking through the cycles, staying invested, and possibly one quirk which I would want to pinpoint is pay more heed to valuations. In any country, if you were to buy stocks, if they were cheap or below average valuations, you stand a chance to make better returns, probably even double-digit returns. But if you buy markets when they're expensive, your longer-term returns invariably go down. So I think these probably 2-3 lessons are very, very important for long-term investors to understand. A, be conservative. B, tone down your return expectations from what you have seen over the last 2-3 years. And 3, pay a lot of attention to valuations.
Right. Sahil, just a quick word on the markets as well. I want to understand, by now you must have done bulk of your number crunching. The kind of quality of numbers we saw this earnings season versus the valuation we are looking at 1 year forward. How does it look? What is the kind of earnings growth picture emerging?
Ajit, there is still, I think, a tug of war happening between earnings growth and valuations. When you look at the top line growth, it has already slowed. About 4-6 quarters ago, we were talking about high double-digit top-line growth. Now we are hovering between 5 to 10% top-line growth. Margins have been exceedingly strong, right? Between, let's say, corporate listed universe at 11.5% MAT margins, and listed plus unlisted universe hovering at 13% PAT margins. These are unprecedented numbers. We haven't seen that. And that has been a major contributor in earnings growth. But as things stand today, when you look at, let's say, NSE 500 consolidated picture trading at 24-25 times trailing earnings, with a top line growth between 7 to 8% and PAT margins which do not have any more room to grow, I think probably we should reduce our return expectation over the next 1 to 2 years. Our estimate probably tells us that when you look at it from a bottoms up point of view, earnings growth could be between 10 to 15% with an error rate. Best case could be the median of this number around 12.5%. If that is the case, then probably market could see some derating. It may not continue to trade at 24 times. So probably look for cheaper parts in the market. There are, of course, large sectors which are trading at fair or discount to their average valuations. That could be a place to hide. But for now, I think being more conservative could be a lot more helpful.
All right. Thank you very much for that, for your time today. Great chatting always, Sahil. Sahil Kapoor of DSP. Meanwhile, hear out Chetanaya, what exactly did he...
If you like this video, then like, share and subscribe to ET Now.